Here's a brutal truth that will save your trading career. Jesse Livermore made and lost 3 fortunes before he learned the one rule that changed everything. The first time he went broke, he blamed market manipulation. The second time, bad luck and poor timing. But after his third bankruptcy, sitting alone in a cramped office with nothing but a pencil and paper, he discovered the invisible force that had been destroying him all along. Picture this scene. It's 1915. Livermore is 38 years old and completely wiped out. Again. The man who once controlled entire cotton markets sits in silence, tracing through every trade in his ledgers. He's not looking for bad predictions. He's looking for the pattern that connects winning streaks to total collapse. What he found in those numbers changed everything. 2 traders walk into the market on Monday morning. Both have identical strategies. Both have studied price action for years. Both win exactly 60% of their trades. Same entries. Same exits. Same edge. They even trade the same stocks at the same pivotal points. Yet 18 months later, one has compounded wealth into a small fortune. The other has blown up his account and is searching for a new career. The difference isn't intelligence. It isn't market knowledge. It isn't access to better information or faster execution. It isn't even luck. The difference is one quiet number that amateurs ignore and professionals obsess over: how much they risk per trade. Let me show you exactly what this looks like. Trader A sees a perfect setup. His analysis is solid. The chart screams opportunity. He risks 10% of his account because he believes in his thesis. The trade goes against him. He loses 10%. No problem, he thinks. I'll make it back on the next one. He takes another trade with the same conviction. Another 10% loss. Now he's down roughly 19% of his original capital. The psychology has shifted. He needs bigger wins just to break even. Pressure mounts. He starts forcing trades. Within 6 months, he's working at a coffee shop. Trader B sees the same setups, same analysis, same conviction. But he risks only 1% per trade. 2 losses cost him 2% of his capital. Painful? Yes. But his mind stays clear. His decision-making stays sharp. He can take the next setup without desperation clouding his judgment. 5 years later, he's still trading. 10 years later, he's wealthy. Same strategy. Different outcomes. The only variable is position size. Here's what Livermore realized in that empty office. You can be right about market direction and still go broke. You can predict 9 out of 10 moves correctly and still end up bankrupt if your position sizing is wrong. The market doesn't care about your analysis. It only cares whether you'll survive long enough to be there when you're finally right at the right time. Think about the emotional toll of oversized positions. When you risk 5% per trade, 2 bad trades put you in a 10% hole. Suddenly you're trading with fear. You need to make it back. Your IQ drops 20 points because fight or flight kicks in. You start seeing patterns that aren't there. You're now trading for survival, not profit. The trader risking 1% takes the same 2 losses. Down 2%. It's a business expense. Their pulse hasn't moved. They come to the screens the next day with a clear mind, ready to execute their edge without emotional baggage. Amateurs ask, how much can I make on this trade? They calculate potential profits. They imagine lifestyle changes. They count future money before the trade even moves. Professionals ask, how much can I lose and still think clearly tomorrow? They calculate maximum damage. They plan their survival before they plan their victory. The answer separates the solvent from the bankrupt. Never risk more than 1% of your capital on any single trade. Livermore called it his survival math. Wall Street called it paranoid. Other traders mocked him for being too conservative. But it's the reason he could control millions of dollars and sleep soundly, while others were begging for loans. Here's what happened when he finally implemented this rule. In 1929, Livermore was short during the greatest crash in history. He made roughly $100 million in today's money. But here's what most people don't know. He built that position over time, adding small increments, each risking only 1% of his growing capital. He didn't bet everything on one massive short. He probed. He tested. He added when the market confirmed his thesis. Because each position was sized to risk only 1%, he could withstand being early. He could survive the rallies that shook out other bears. He could wait. You're about to learn why the 1% rule isn't conservative at all. It's actually the most aggressive strategy you can deploy. Because the trader who survives 20 consecutive losses is the trader who's still standing when the monster move finally arrives. Most traders have this backward. They think aggressive means big positions. They think conservative means small positions. But the truly aggressive trader ensures they'll be around for the next opportunity. The truly conservative trader bets big and prays. Think about it. What's more aggressive, risking 10% per trade and being forced out after 6 losses, or risking 1% per trade and still having 80% of your capital after 20 losses? The second trader is still hunting, still dangerous, still in the game. The first trader is telling anyone who will listen about the trade that almost made them rich. This is the identity shift that separates professionals from amateurs. The amateur wants to be a prophet. The professional is content to be a risk manager. Your capital is your inventory. A store owner who loses all inventory closes the shop. A trader who loses their capital is out of business. The primary job of a trader isn't to make money. It's to protect the inventory. Profits are just a byproduct of doing that job well. But understanding why the 1% rule works requires facing something uncomfortable. We need to examine the arithmetic that destroys trading accounts. The math that shows why being mostly right can still leave you broke. The numbers that prove you can win more than you lose and still end up with nothing. That's where we're going next. Because once you see these numbers, you'll understand why Livermore spent months doing calculations after his third bankruptcy, and why he never violated the 1% rule again, even when managing millions. Let's make this painfully clear with real numbers. You start with $10,000. You risk 5% per trade because you believe in your setup. That's $500 at risk every time you click buy. It doesn't feel reckless. You tell yourself this is disciplined trading. You're not gambling, you're investing with conviction. This is how most traders quietly walk toward the edge of a cliff without realizing the ground is crumbling beneath their feet. Now imagine 7 losing trades in a row. Your brain immediately protests. 7 in a row? That's extreme. It isn't. Every trader with enough screen time has lived through far worse. Markets cluster losses like storm clouds. Bad conditions come in streaks. Your strategy can stay cold longer than your account can stay funded if your position sizing is wrong. After 7 losses at 5% risk, your account isn't down 35%. That's the first dangerous illusion amateurs cling to. Losses compound against a shrinking base. The mathematics work like this. 10,000.95, Hales is 7, $6,983. You're down roughly 30%, sitting with just under $7,000. $3,000 of your hard-earned capital has evaporated. But here's where the real trap closes its jaws. To recover that $3,000 loss, you don't need a 30% gain. You're now working with a smaller base. You need to turn. 6,983 into 10,000. That requires a 43% return just to break even. Not to make profit. Not to get ahead. Just to return to your starting line. This is the asymmetry that destroys traders. The mathematics don't care about your feelings or your analysis. They don't forgive. They compound against you with cold precision. Lose 50% of your account? You need a 100% return to get back to zero. The hole gets deeper faster than you can climb out. Livermore understood this viscerally after his second bankruptcy. He wasn't stupid. He wasn't inexperienced. He simply ignored the arithmetic of ruin. After that collapse, he sat down with ledgers and calculated exactly how many consecutive losses he could survive at different risk levels. No optimism. No, this can't happen to me. Just cold numbers on paper. Here's what his analysis revealed. Risk 10% per trade, 6 consecutive losses, and you're down nearly 47%. Your psychology is shattered. You need an 88% return just to break even. Most traders either quit or blow up trying to recover. Risk 5% per trade, 12 consecutive losses, and you're down approximately 46%. The pressure becomes overwhelming. Desperation replaces discipline. You start taking trades you shouldn't, forcing setups that aren't there. Risk 1% per trade, 20 consecutive losses, and you still have over 80% of your capital. You're bruised and frustrated, but you're still dangerous. Your decision-making ability remains intact. That's not theory. That's the arithmetic of ruin. To put this in perspective, if you have a strategy that wins 50% of the time, the probability of 20 straight losses is roughly 1 in a million. Yet even in that worst-case scenario, the 1% trader survives with most of their capital intact. Now watch what happens when you flip the script. Same $10,000 account. Same unfortunate streak of 7 consecutive losses. But this time, you cap risk at 1% per trade. Maximum loss per trade, $100. The mathematics, 10,000.99 in 7 taus, $9,321. 7 losses cost you approximately $679. Your account sits at $9,321. Painful? Absolutely. Nobody enjoys losing. But fatal? Not even close. You still have over 93% of your capital and the psychological strength to take the next high-probability setup. Here's what most traders miss. The emotional impact of being down 7% versus being down 30% isn't just about numbers. It's about psychology. At minus 30%, traders enter fight or flight mode. They start revenge trading. They double their size. They remove stops entirely. They abandon their rules in the exact moment they need them most. One emotional decision in that state can finish the account. At minus 7%, professionals do the opposite. They slow down. They review their process. They ask whether this is statistical drawdown or if something fundamental changed. They have the emotional room to think clearly because their risk management preserved their mental capital alongside their financial capital. Consider what happens when both traders finally get their winner. After that 7-trade losing streak, both take the next trade and capture a 10% move. Trader A, down to $6,983, makes $698, still down $2,319 from the starting point. Trader B, down to $9,321, makes $932, only down $747 from the starting point. The gap widens with every trade because compounding works both ways. Here's the identity gap that separates professionals from amateurs, and it's all in how they think about risk. I can't make real money only risking 1%. They see small position sizes as limiting. They believe big wins require big bets. They're focused entirely on the upside while ignoring the mathematics of drawdown. I can't stay in this business if I risk more than 1%. They see small position sizes as the foundation of longevity. They understand that staying in the game is the prerequisite for everything else. They're focused on survival first, profit second. The first mindset chases thrills. It seeks the dopamine rush of large positions and quick profits. It treats the market like a casino where you're trying to hit the jackpot before the bouncer throws you out. The second mindset builds careers. It embraces the boring discipline of risk management. It treats trading like a construction project, brick by brick, carefully placed, built to withstand hurricanes. Here's the paradox that confuses most people. The boring approach is actually the aggressive one. The trader who risks 1% can take more high-probability setups because they're not worried about any single trade destroying them. They can be aggressive in their strategy execution because their risk management is bulletproof. The trader risking 5% or 10% per trade looks aggressive, but is actually trading scared. They can't take every good setup because they're terrified of the next losing streak. One bad week can ruin them. They're not free to execute their edge. They're handcuffed by their own poor risk management. Livermore proved this throughout the 1920s. Once he implemented the 1% rule, he became more aggressive in his market participation, not less. He could short stocks during rallies because he knew the maximum damage. He could hold through violent shakeouts because his position sizes didn't threaten his survival. Your account balance isn't a scorecard. It's your lifeline. It's the only thing keeping you in the game. The moment you disrespect the mathematics of ruin, the game is over. The market is a mechanism for transferring wealth from the impatient to the patient, from the reckless to the disciplined. But protecting your capital is only half the equation. Understanding the arithmetic of ruin tells you what not to do. It doesn't tell you how to build wealth. The real question burning in your mind right now is, if I'm only risking 1%, how do I ever turn this into meaningful money? That's where the real sophistication comes in. Small risk per trade doesn't mean small results over time. The professional stacks those small risks intelligently, using a technique that most traders get completely wrong. It requires you to rethink everything you know about how to size a position. And that's exactly what we're going to break down next. Most traders size their positions backward. They see a stock they like, check their buying power, and decide they want to buy 500 shares because it feels right. Then they force a stop loss somewhere to fit their desires, usually at a round number or wherever their account can handle the damage. The stop becomes an afterthought, a formality to satisfy some vague notion of risk management. That's amateur hour. That's how accounts die slowly, one emotional decision at a time. Professionals work in reverse. They don't start with how big they want the win to be. They start with how small they insist the loss must be. It's the difference between driving by deciding your speed first and hoping the road cooperates, versus reading the road conditions and adjusting your speed accordingly. They begin with their maximum acceptable damage, then let mathematics determine position size. Here's Livermore's exact protocol, the framework he used to control millions of dollars without losing sleep. No guesswork, no emotion, just mathematical precision that removes negotiation with yourself. This number is sacred. Account equity, $10,000. 1% maximum risk, $100. This doesn't change based on how confident you feel. It doesn't flex because the setup looks perfect. You're declaring to the market before you even look at a chart. This is what I'm willing to lose on this single idea, and not a penny more. Most traders skip this step entirely. They look at the opportunity first, fall in love with the potential, then rationalize the risk afterward. That's backward. The professional decides their risk budget before they fall in love with the trade. You want to buy a stock at $50. Now you ask the only question that matters: where is this thesis wrong? Not where would I like to be wrong. Not where feels comfortable. Where does price action prove my analysis is incorrect? The chart shows solid support at $48. Multiple tests. Volume confirmation. Below that level, the structure breaks. Buyers have given up. Your entire reason for being in the trade is invalidated. That's your stop. Not $47.50 because you want more room. Not $48.50 because you want less risk. The market tells you where the line is drawn. Risk per share. $50 minus $48 equals $2. That's the distance between your entry and your invalidation point. That's the price of being wrong on this particular trade. Position size equals $100 divided by $2 equals 50 shares. That's your answer. The only position size that respects both your risk limit and the market structure. Not 500 shares because you're confident. Not 200 shares because the stock looks good. The mathematics decide. Your emotions don't get a vote. This single shift, from emotional sizing to mathematical sizing, is the line between survival and eventual ruin. Watch what happens when you ignore this framework. The amateur sees the same stock at 50 and says, I want to make real money on this move. They buy 500 shares, putting $25,000 of exposure on a $10,000 account, using margin. A $2 move against them, down to 48, equals a $1,000 loss. That's 10% of their account. A normal fluctuation becomes a catastrophic event. The professional buys 50 shares. A move to 48 costs exactly their planned $100. Same chart, same entry, completely different emotional experience. One trader is staring at screens, heart racing, begging the stock to bounce. The other is calm, already knowing this scenario was fully accounted for before entry. This framework isn't just for single positions. It's the foundation for pyramiding, building massive exposure without massive risk. Livermore didn't start with huge bets. He started with what he called a probe, testing his thesis with minimal capital. 50 shares at $50, risking $100. If the stock moved against him, he was out with a small, controlled loss. But if the market confirmed his read by moving in his favor, only then would he consider adding. Let's say the stock rallies to $52. He's up $2 per share on 50 shares, $100 in profit. His stop on that first position moves to break even. The market has validated his thesis. The stock pulls back to 51, finds support, starts moving higher again. He adds a second position. Same process. 1% risk. New stop loss at $49.50 based on current market structure. Risk per share, $1.50. Position size, $100 divided by $1.50 equals 66 shares. Each additional position follows the same 1% rule, but here's the crucial difference. He's building on profits, not hope. The first position is already profitable. His total exposure is growing, but his total risk isn't compounding dangerously. This is how professionals amplify gains without amplifying risk. The amateur doubles down on losing positions to average down, hoping for recovery. The professional adds to winning positions at logical points, riding confirmed strength. One strategy compounds losses. The other compounds winners. Here's the maxim that changed everything for him. The entry is an opinion. The stop is a fact. Size from the fact. Your entry point is your best educated guess about where price will go. Your stop loss is where the chart definitively proves you're wrong. One is subjective. The other is objective. Always size your position from the objective fact, not the subjective opinion. Think about the psychological freedom this creates. When you know before you enter exactly what the worst-case scenario costs in dollars, and you know that cost is survivable, trading becomes mechanical. You're not lying awake wondering if tomorrow's gap will ruin you. You already know the maximum damage. You've already accepted it. This formula also acts as a filter, automatically removing low-quality setups. If the logical stop is so wide that your 1% risk only allows 10 shares, maybe the trade isn't worth taking. Maybe you wait for a better entry where the risk-reward structure makes sense. But position sizing is only part of the equation. You can have perfect risk management and still destroy your account if you're taking 50 trades monthly on mediocre setups. The real edge comes from understanding when to do nothing at all. That's the lesson most traders never learn, and it's exactly what we need to explore next. Here's where most traders get completely confused, and it reveals everything about their mindset. They hear risk 1% per trade and immediately think they'll never make meaningful money. They do the mental math. 1% of 10,000 is $100. Even if I'm right, how much can I possibly make? The calculation feels limiting, almost insulting to their ambitions. This is the exact moment where amateurs reveal themselves, because they're thinking about single trades instead of campaigns. Dead wrong. Livermore didn't make his millions from one giant bet. He didn't wake up one morning, risk everything on a single position, and retire wealthy. He made his fortune through pyramiding, adding to winning positions in controlled strategic increments. But here's the key that separates this from reckless gambling. He only pyramided after the market proved he was right. Not after he felt more confident. Not after reading more news. After price action confirmed his thesis with actual movement. The difference between amateur hope and professional confirmation is everything. Amateurs add to losing positions, praying for recovery. Professionals add to winning positions, riding confirmed strength. One strategy compounds losses until they become fatal. The other compounds winners until they become life-changing. Picture this scenario in detail. You have a $10,000 account. You spot a strong stock breaking out at $50, with clear support at $48. You run the math like a professional. Risk per share is $2. Maximum risk is $100, so position size equals 50 shares. You enter. Your risk is defined. You can sleep. The stock starts moving in your favor. It climbs from 50 to 53 over several days, hitting your first profit target. You're up $3 per share on 50 shares, $150 in open profit. At this critical moment, the amateur and professional part ways completely. The amateur sees green on the screen and panics about giving it back. They close the entire position, book the quick win, and immediately start hunting for the next setup. They're perpetually starting over from zero, killing their best ideas too early because they can't tolerate the discomfort of success. The professional does something counterintuitive. They move their stop on the original 50 shares to break even, locking in protection. Then they wait for the next pivotal point. The stock pulls back to 52, finds support, and starts pushing back through 53 with volume. That's confirmation. They add a second position. New calculation. Stop loss at $50 based on the pullback low, entry at 53, Risk per share is $3. $100 divided by 3 equals 33 shares. They add that exact amount, still keeping risk on the new position capped at 1%. Now they're holding 83 shares total. The first 50 shares are protected at break-even, with $3 per share in cushion. The second 33 shares risk exactly $100. Total capital at genuine risk, $100. Total exposure, over $4,000. They've quadrupled their exposure while maintaining their original risk limit. The stock continues higher to $56. Another pullback to $54.50. Another base formation. Another breakout with confirmation. They add a third position. Stop at $52.50. Entry at $56. Risk per share $3.50. $100 divided by 350 equals 28 shares. Now the mathematics get beautiful. 3 positions working together. First position, 50 shares bought at 50. Now up $6 equals $300 profit. Second position, 33 shares bought at 53. Now up $3 equals $99 profit. Third position, 28 shares bought at 56. Just started. Total profit so far, nearly $400 on $100 initial risk. 4-to-1 return and still building. But here's what most people miss. Their actual capital at risk throughout this entire sequence never exceeded $100. The first position's stop moved to break even after the ad. The second position's stop protected against major loss. Only the newest position carried fresh risk. They built a pyramid on a foundation of confirmed profits, not hope. This is how professionals amplify gains without amplifying danger. Each layer of the pyramid is supported by the layer beneath it. The structure grows larger, but remains stable, because every addition is validated by market movement. They're using the market's money to finance additional exposure, not throwing good money after bad. Compare this to the amateur's instinct. They buy at 50, the stock drops to 48, and they buy more shares to lower their average cost. Now they're adding to a position the market has already rejected. They're compounding their error, increasing exposure to a losing thesis. This is averaging down, the fastest way to turn a small loss into a catastrophic one. Here's the identity shift that matters most. Amateur behavior, add to losers, hoping they recover. They trade from ego, refusing to admit error. They fight the market, convinced it must turn around. Professional behavior, add to winners, riding confirmed strength. They trade from humility, letting price action dictate exposure. They flow with the market, accepting its verdict as truth. Livermore called this letting your profits run while keeping your risk fixed. It's a paradox that confuses most traders. You're increasing potential reward exponentially while keeping initial risk linear. Each new position still respects the 1% rule. You never expose your core capital to ruin. You're simply reinvesting the market's generosity back into the move. The trader who risks 10% per trade might catch one big winner. They'll feel like a genius for a week. But inevitably, a losing streak hits. Because their risk is too high, they blow up before the next opportunity arrives. The trader who risks 1% can catch 10 big winners in a row, because they're still in the game. They survive the noise. They survive the false breakouts. They survive the inevitable cold streaks. And when the real trend emerges, they're positioned to pyramid into it and extract maximum value. Small risk doesn't mean small returns. It means sustainable returns. It means having the staying power to let compounding work its magic. You're building wealth on a foundation of granite, not sand. But pyramiding demands one skill that destroys more traders than bad analysis or poor timing. The ability to wait. To wait for confirmation. To wait for strength. To do nothing when nothing is clear. That hidden enemy, impatience, can destroy even perfect position sizing. Livermore spent more time out of the market than in it. During the peak of his career, managing millions of dollars, he once went 6 entire months without placing a single trade. Not because he lost his nerve or couldn't find opportunities. He sat in his office every trading day, reading the tape, analyzing price action, studying market behavior, and deliberately chose to do nothing. When other traders questioned his inactivity, almost mocking his apparent lack of engagement, he delivered one of the most profound insights in trading history. Waiting is a position, and sometimes it's the most profitable one. Most traders cannot fathom this level of discipline. They are psychologically addicted to action, to the dopamine rush of clicking buy or sell buttons. They need to be in a trade, any trade, because sitting still with cash feels like losing money. Every uptick they miss feels like a personal failure. Every quiet trading session feels like wasted time. This addiction to constant activity has destroyed more trading accounts than bad analysis, poor timing, or even excessive leverage ever could. Here's the brutal mathematical truth that separates survivors from casualties. The trader who takes 50 trades per year at 2% risk is far more likely to blow up than the trader who takes 10 trades per year at 1% risk. Let's examine why with concrete numbers. 50 trades at 2% risk with a 60% win rate means 30 winners and 20 losers. Those 20 losses expose you to a maximum theoretical risk of 40% of your capital, but compounding makes the damage worse. More critically, you're making 50 separate decisions under pressure, creating 50 opportunities for emotional mistakes, decision fatigue, and rule violations. You're volunteering to be chopped up by market noise instead of waiting for clear signals. 10 trades at 1% risk with the same 60% win rate means 6 winners and 4 losers. Maximum theoretical loss exposure, 4% of your capital. More importantly, you're only making 10 high-conviction decisions per year. Each trade receives your full attention and analysis. You're conserving mental energy for the setups that truly matter. The 1% rule forces patience in a way that higher risk percentages never can. When you treat each trade as a small, controlled piece of a larger campaign, you stop chasing mediocre setups. You stop forcing entries out of boredom or fear of missing out. You start waiting for what Livermore called pivotal points. Those rare moments where multiple factors converge to create low risk and asymmetrically high reward potential. A true pivotal point isn't just any support or resistance level. It's where strong technical structure meets clear invalidation points, favorable risk-reward ratios, and confirmation from price action. These moments don't appear daily or even weekly. Sometimes they don't appear for months. The amateur can't tolerate this silence. The professional lives for it because they understand that excellence requires patience. Here's the psychological trap that destroys most traders. They confuse activity with progress. In almost every other profession, more effort equals better results. Work more hours, earn more money, make more sales calls, close more deals. But trading operates on inverse logic. More trades usually mean more exposure to randomness, more commissions, more emotional decisions, and more opportunities to violate your rules when fatigue sets in. Livermore understood this at a cellular level. He said, "It was never my thinking that made the big money for me. It was always my sitting." Not his brilliant analysis or perfect entries. His ability to sit still when conditions weren't ideal, and his discipline to sit still when he was already in winning positions. Both forms of patience are equally difficult and equally essential. The amateur treats every market day like an opportunity. They wake up thinking they need to find something to trade. The psychological pressure to do something with their time becomes overwhelming. If they're not actively trading, they don't feel like traders. The professional treats most days like noise. They understand that clarity is rare, and that the big money, the kind that changes lives, comes from a handful of exceptional trades per year, not dozens of mediocre ones. The 1% rule ensures they're still financially and emotionally intact when those rare opportunities finally arrive. Consider this scenario that tests every trader's discipline. You already have 3 positions open, each risking 1% of your account. That's 3% total exposure across your best ideas. Your attention is divided between monitoring these positions, managing stops, and watching for pyramid opportunities. Then you spot another setup. It's not exceptional. The volume is light. The pattern is unclear, but it's moving, and you feel that familiar itch. 2 voices battle in your head. The amateur voice whispers, "It's only another 1%. Take it. What's the harm? You need to stay active. What if this one runs and you miss it?" The professional voice responds firmly, "My capital is already deployed in superior positions. My attention is already divided. This setup is inferior to what I already hold. Adding mediocre trades dilutes my focus from excellent ones. Waiting is my best position right now." This internal battle determines your career trajectory. The amateur voice sounds reasonable, but that's how discipline erodes, one small compromise at a time. Soon you're holding 6 positions, none of them high conviction, all demanding attention you can't properly provide. Your capital is your ammunition. A skilled sniper doesn't fire at every shadow or movement. They wait for clear shots at high-value targets. They conserve resources for moments that matter. The trader with limited capital, which is every trader, must think identically. Don't waste ammunition on average opportunities. Save it for battles that actually matter, where everything aligns in your favor. Patience also protects your psychology in subtle but crucial ways. Constant trading keeps your emotional state perpetually elevated. Wins pump you up, losses drag you down. You ride a daily roller coaster that exhausts your decision-making capacity. Sitting out, conversely, keeps you centered. You observe without attachment. You study patterns without feeling the sting of every adverse tick. That emotional distance becomes a genuine edge. The discipline to do nothing is what allows you to do something significant when it truly matters. Livermore proved this repeatedly throughout his career. His biggest wins didn't come from constant activity, but from patient accumulation during clear trends. When the moment finally arrived, he deployed capital with overwhelming force and conviction. But even the greatest master of patience and risk management can forget these fundamental rules. In our final chapter, we'll examine what happens when even Jesse Livermore abandoned the discipline that made him wealthy, and how that tragic ending provides the most important lesson of all. Let's close the loop with a sobering truth that every trader needs burned into their consciousness. Jesse Livermore, the man who made $100 million in the 1929 crash, equivalent to roughly $2 billion in today's money, died broke in 1940. Not because he lost his trading ability. Not because he couldn't read the tape anymore. Not because markets evolved beyond his understanding. He died broke because he forgot his own rules. The very discipline that built his fortune became the casualty of his success. Picture the tragic irony. Livermore had learned the 1% rule through 3 devastating bankruptcies. He had documented it. He had lived by it during his most successful years. He understood the mathematics of ruin better than almost anyone alive. Yet even he, with all that painful experience, eventually convinced himself he was special enough to ignore it. If it happened to the greatest trader in history, it can happen to anyone. In his later years, success bred a dangerous form of arrogance. Livermore abandoned the strict risk discipline that had carried him through decades of market warfare. He started taking larger positions, reasoning that his experience made him immune to the mathematical laws of ruin. He began risking 5% per trade, then 10%, then more. The justifications were endless. I know this market better than anyone. I've seen this pattern 1,000 times. My track record speaks for itself. The market is patient, and the market is utterly unforgiving. It didn't care about his legendary status or respect his decades of experience. It simply applied the arithmetic of ruin with cold precision. Larger position sizes meant larger losses. Larger losses meant psychological pressure. Psychological pressure meant emotional decisions. Emotional decisions meant abandoning discipline at the exact moment he needed it most. The spiral accelerated until the money was gone. This is the final and most critical lesson. The 1% rule isn't a training wheel you remove once you become skilled. It's not a beginner's constraint you outgrow with experience. It's the only thing standing between you and financial oblivion, regardless of your talent, knowledge, or track record. The moment you think you've transcended the need for strict risk management is precisely the moment you're most vulnerable to catastrophic loss. Here's your daily protocol, written in stone, non-negotiable regardless of your experience level or recent success. Calculate your 1% risk before every single trade. This must be a ritual. If your account is $50,000, your maximum loss is $500. No exceptions. Not when you're sure about the setup. Not when you've won 5 trades in a row. Not when the opportunity feels once in a lifetime. The calculation happens first, before analysis, before entry, before anything else. This number is your anchor to reality. Size from your stop loss, never from your desires or confidence level. Find the logical level where your thesis is definitively broken. Calculate the distance in dollars or points, then divide your maximum risk by that distance. The mathematics determine your position size. Your emotions, intuition, and conviction don't get a vote. The moment you start negotiating with this formula is the moment discipline begins eroding. Probe first, pyramid second. Start with 1 unit sized according to your 1% risk. This is your reconnaissance mission, testing whether the market agrees with your thesis. Only add to positions that are already profitable and confirmed by actual price movement. Each addition follows the same 1% rule, building exposure on profits, not hope. Never add to losing positions. The market's rejection of your initial entry is information. Respect it. Cut losses instantly. Let winners breathe. When price hits your predetermined stop loss, you exit immediately. No waiting for a bounce. No hoping it'll come back. No checking news for reasons to stay. The stop was set for a reason. Honor it. Conversely, when price moves in your favor, resist the urge to grab quick profits. Move your stop to protect gains, but give the position room to develop. Most traders hold losers too long and cut winners too quickly. This single behavioral error destroys more accounts than any other. Treat waiting as a valid position. Cash is not a punishment for missing trades. It's preparation, ammunition, and optionality for the next genuine high-probability opportunity. When you have no positions meeting your criteria, your position is cash. When you already have sufficient exposure, your position is monitoring existing trades. Both are active positions requiring discipline to maintain. The amateur dreams of the one trade that changes everything. They're constantly searching for that lottery ticket, that perfect setup that will make them rich overnight. This mindset keeps them perpetually chasing, perpetually disappointed, perpetually exposing themselves to ruin. The professional knows there is no single trade. There's only the process, repeated with discipline day after day, protected by position sizing that ensures survival. Wealth compounds from dozens of well-managed trades over years, not from one heroic bet. The professional's edge isn't prediction, it's process adherence. Livermore's tragedy proves the rule with heartbreaking clarity: survive first, profit second. You cannot compound wealth if you're not in the game. The 1% rule ensures you'll still be trading when the next great opportunity reveals itself. It ensures you'll have capital when clarity emerges from chaos. It ensures your psychology stays intact through inevitable losing streaks. This isn't about being conservative or timid. It's about being ruthlessly aggressive in the right way. The trader who survives 20 years compounds knowledge, experience, and capital in ways that the trader who blows up after 18 months never can. Time in the market, protected by proper risk management, is the ultimate edge. The market will test you. It will tempt you to bet bigger when you're winning. It will seduce you with easy profits that make discipline feel unnecessary. It will punish you with frustrating losses that make patience feel stupid. Your job is singular. Follow the protocol regardless of recent results, regardless of how you feel, regardless of how confident you are. Livermore gave us the blueprint through his success. He also gave us the warning through his failure. The choice of which lesson to learn is yours. Cut losses fast. Size small. Wait for confirmation. Own your process. That's how you manage millions without losing sleep. That's how you honor the lessons Livermore learned the hard way, so you don't have to.